been said that this pandemic for credit will be similar to what demonetization was for payments. I just wanted to know your views in terms of whether do you agree with that statement and how do you see the pandemic changing the lending?
For us as a bank, I think the existence came into play because of the need we felt for a digitization. What this has done is this has kind of forced it into focus. And if you look at the lending value chain as a whole, there is of course the identity and KYC which we spoke about. But beyond that, the underwriting, the disbursement, the servicing, all the rails were already in place. It was just about plugging them. So this is exactly the shot in the arm that was required to sort of get it going at an industry-wide level across products.
So when moratorium was introduced, so many of the bankers were, unsure how what will be the impact of the COVID pandemic on the borrowers. So they had, made the lending criteria strict, and they have admitted it. So I want to ask you that has things changed, after the moratorium is over? Is there any change in the lending criteria after moratorium?
The response to a black swan event like the pandemic, and none of us knew what it meant even when the lockdown started, right? Mid-March. We were all hoping against hope things will become normal. Your response to uncertainty is a flight to safety or comfort, right? The underwriting fundamentals, I don't think have changed, right? If you talk about underwriting, it's basically you identifying the customer, verifying the customer, and the intention and the ability to play. As Anshul rightly pointed out, the bureau became a very sort of pivotal port of call to get that information for customers who were on the bureau. And on the fringe on NTC, you would look at other ways of underwriting customers, look for other indications. Now what happened is that period of 6 months, first of all, when it started, nobody knew it would be 6 months. It started out as 3 months, more as a relief measure. Now, your usual port of call doesn't give you the requisite information. Then you will rely either on information that you have about the customer if he or she banks with you, or whatever information you can get sort of in the public domain. So that flight to safety, I think, happened. Second thing is that as we get out of moratorium now, and it's been a good 6 months, there are a few things that we are seeing, right? We are seeing that, first of all, there is a habit. EMI itself is a habit, and that's why it's a discipline. So you're seeing that customers may have the ability to pay, but are out of habit. You've also seen workforce migration. I think the next couple of months are critical, for anybody to form a view on what the future will hold, the broad recovery aside. So I think it's the response to uncertainty, Renu, if I could answer that. I don't think it was necessarily tightening the criteria. It was more a response to what happened.
But if I just ask you to structurally talk about what are the expectations then you have from the upcoming festival season, what are the kind of pickup that you have seen? Maybe if there are some segments that you have seen having more demand than the other, can you just talk about a bit on your expectations and things that you're looking at for this upcoming festival season?
Yeah, no, I was saying I wish I had a crystal ball to give you the answer, Dinesh, but it's a really tough one, frankly,
Okay.
especially for the businesses that we are in. I would agree that personal loans, because it's discretionary, will take some time. Property loans, I always feel whenever you have the money and you're renting versus buying, if you think you can make the mathematics of it works, it's a good time unless property is overpriced. For the rest of the loans, I do think there will be some bounce back, but frankly, we don't know to what level, because added to the fact is that people are getting out of moratorium, and even the institutions are sort of watching what the future has in store. So it's going to be an interesting time. I would say October and November would be very, very interesting and probably define how 2021 would look like. Yeah.
So my question is, how do lenders look at restructuring of loans? When a borrower opts for a restructuring of loan, so how does lender look at it? So are they considered as defaulters? So like as per the RBI guidelines, they will be reported as restructured loans to the credit bureau. So what will be the impact of the same on the credit score of the borrowers?
I think in my view, it's not a yes or no answer. I agree with what Adhir said, and I think he's been quite candid about his view here. The challenge is that customers did take a choice, and some of them they felt necessary because of their circumstances, and that's exactly why the moratorium was offered. And some of them chose to take a view basis their view on their future cash flows, even if they currently had not impacted. So when we educated customers, our view to the customers was, look, if you can pay, it is prudent to pay, right? Because at the end of the day, this payment will have to be done later. So regardless of what choice the customers took, it really now comes down to what are the various options. I would say restructure is one option, and of course, extension of moratorium selectively is the other option, right, on a case by case basis. I will say that bureaus will also figure out what is the best way to incorporate this event, right? Uh, my view is that this will be a determinant in future decision making because it was on account of lack of ability to pay. But we will have to come up with some kind of overlay given the circumstances. So, in a nutshell, would I say it would not be? It would be something that we ignored? Probably not. But it would be a clear yes/no answer. No, I think we'll have to figure out how to deal with it, and it's too early right now to say.